Hello everyone and welcome to this week's webcast. My name is John Carl Brew and I'm the Director of Municipal Credit Analytics here at Seafried and Brew. Last week our Chief Analyst Jamie Sumner discussed how rising interest rates are driving down bond valuations in the investment portfolio. And we said that you need to check credit risk in the municipal bond portfolio in response. So this week we're going to look at some of the municipal credit forces that are affecting municipal credit risk in 2022 and beyond. First, we want to give an overview of municipal credit quality. And we can see that average rating S&P 1- through 2019, very strong. The strongest rating is an S&P 1, and the weakest rating is an S&P 4. That's for non-investment grade bond. However, in 2020, you see that rating start to move towards an S&P 2+, and that had to do with the pandemic. Now, there was a pandemic disruption in the short term, and we anticipate in the long term as well. In the short term, we saw revenue volatility, income tax, sales tax, property tax, charges for service, all fluctuated. We saw sector impacts, higher education, healthcare, transportation, all impacted in the short term, but also structurally going forward. And special tax bonds, those pledged tax revenues, especially in tourism areas, affected significantly by the pandemic. In the long term, we're seeing some tax-based shifts due to the remote work activity and changes in retail preferences. And then we're seeing this federal stimulus relief being the big impactor for the municipal sector. In a survey from the National League of Cities, city finance directors are much more optimistic about the fiscal future, and that has to do with the federal stimulus. And we see that stimulus coming in a significant amount for municipalities, $150 billion from the CARES Act, $361 billion from the American Rescue Plan. So how is that money being spent? Here's a table from the Council of State Governments. We see most of that money spent on lost revenues and lost staffing. However, a lot of the money is being spent on special programs for the other objectives of other opportunities and equity for municipalities. So we see unemployment, information technology, education, community development. So there's some concern that if there's new programs created because of the stimulus money, what's going to happen when that money runs out? And that could have a credit impact in the long term. There is still a public pension crisis in the United States. And while contribution levels have increased and there was some increase in market performance, these funds are still underfunded. You see yellow, orange, and red funded under 80%, and that's going to impact state credit quality, and that's going to impact how much the local governments are required to contribute to those cost-sharing plans. Inflation already impacting in the revenue bond sector, and we're seeing higher material and supply costs driving up operating expenses, which in turn leads to higher rates, which could impact revenue capacity. And then we also anticipate that there'll be impacts from higher labor costs across the municipal sector. When we talk about economic recession, we're primarily concerned about the housing market and the impacts of the housing market on revenue capacity. We see 3 straight months of falling median sale prices of existing homes. And we're already seeing in 2021 that there's an increasing rate of declines in assessed valuation. And so as assessed valuation declines, property tax revenue capacity also declines, affecting revenues and credit qualities for general obligation bonds. And here is a table from that National League of Cities survey showing the different revenues and how there's some sentiment there could be an economic recession. We see sales tax revenues rebounding 4.24%, down 2.5% budgeted for 2022. Income tax revenues up 0.97% on average, down 0.11% for 2022. And the big indicator here, Property tax revenues down 1.09% actual for 2021 in those cities polled, and budgeted down 4.32%. Again, sentiment that there could be an economic recession. Now, will there be more municipal bankruptcy filings? Already, May 19th, 2020, the city of Fairfield, Alabama, filing for a Chapter 9 bankruptcy. There were several municipal bankruptcy filings following the Great Recession. We look at Detroit, Stockton, Jefferson County, several municipal bankruptcies, and we would anticipate that you could see the same thing if there were another prolonged economic recession. We want to show you a snapshot of one of our reports. This is a scorecard section, and this is for an Eastern Pennsylvania municipality that we rated an S&B 4. And you can see how the scorecard shows all the different areas that the credit risk is showing up. We see liquidity and solvency ratios showing very weak. Overall financial management, weak. These other factors that we integrate, pension integrity, debt capacity, financial management trend, weak, moderate, negative, overall contributing to that S&B 4 rating. Now, these reports are instrumental in finding credit problems early in your portfolio and also in monitoring weak credits over time. Now, we do these ratings on an annual basis for every bond in the portfolio, and we update financial statements on a monthly basis to make sure that your ratings are up to date. And this is a great way to check credit in your municipal bond portfolio. I want to thank you for joining us this week, and I hope that you have a great week. Take care now. Goodbye.